Hey guys, just want to welcome you out to our Unlocking Commercial series where we talk about commercial loans and that type of thing. And I have one of my underwriters on the line, Jesse Hagan. And today we're going to discuss pretty much, what does it take? We'll look at a checklist and everything, of course, for an SBA loan. And then, of course, we're going to discuss a couple of deals that we're working on as well. So with that being said, my great friend, Jesse Hagan, she's going to take it away from here.
Thank you, Wendell. I appreciate that. Good afternoon, everyone. Today, we're going to specifically talk about the 7A program and the, parameters when buying an existing business. SBA 7A loans are commonly used for this use, and I would say that probably most bankers, at least 50%, if not closer to 75% of the deals that we're doing these days are changes of ownership in businesses, and there have been some wide sweeping changes in the last year that a lot of people still are not aware of. So we'll go through those today. I'm sharing this document here. I've noted here that the minimum loan size that I will take in is $250,000. The SBA doesn't actually have a minimum. There are, banks, I don't know who they are, but there are banks that'll do $50,000, $100,000 loans, that kind of thing. But my personal experience is that the smaller they are, the longer they take, because the individuals need that much more hand-holding. There's a lot of paperwork. The difficulty is just so much more enormous that over the last 25 years of doing this, I've realized that, there's got to be a cutoff. Otherwise, I could find myself working on projects that are just never going to get closed. And the maximum loan size is $5 million. So it's very wide ranging, lots of small businesses that fit within that range. Here's the important things that people need to understand, and these are some different terms this last time around when the SBA rewrote their rules last November. If somebody is buying a business that doesn't have any real estate included, could be a insurance agency, could be a dental practice, could be an online retailer, a business that just doesn't have any real estate or, is leasing space. That loan is always going to be a 10-year loan to the borrower. Very black and white, very easy for me to state that. If the buyer is buying the commercial real estate that goes with the business, then it depends upon how much that real estate makes up of the overall purchase price, and whether we get a 10-year loan, a 25-year loan, or two loans. So if there's real estate included and that real estate is worth, and this has to be supported with an appraisal, but there has to be an allocation between the various assets that are being acquired in the LOI. And if the real estate constitutes more than 50% of the overall project cost, and I'm very clear to say project cost, not the purchase price, then we can provide one loan for 25 years. Assisted living facilities are a good example. Hotels are a good example where that's almost always going to be, the situation where we have more than 51% of the value in the real estate. If there's a case where we've got smaller amount of real estate, then we have to break it up and we finance the business assets and intangibles on one 10-year note and the real estate on a 25-year note. So really important information for people to know, and very important that the initial purchase agreement, whether it be an offer to purchase or an LOI, has an allocation of the assets being acquired. Interest rates are all adjustable interest rates these days. They're always tied to the Wall Street Journal prime rate, which is 8.5%. And the spread over that initial base rate of prime can range from 1 up to 3%, and that's determined by the SBA. I will tell you that the smaller the loan, the more the SBA allows the banks to charge. So literally, if I was doing a small $100,000 loan, I could charge up to, I think it's 4% over prime, maybe even 5%. Because I don't do those kinds of loans, I don't even have that committed to memory. SBA fees. Good news, once again, the SBA is waiving all the fees for any SBA loans under $1 million. That's pretty big because, we're talking about If it was $1 million loan, the SBA fee would be around $28,000. Other closing costs, and loans that are over $1 million, it's actually a blended increasing rate. So I tell people for simplicity that just assume 2.75% of the loan amount. Fees always can be rolled into the project. So they're not on, not the purchase price plus these fees. It's plus all these fees and working capital to come up with the project definition. Assume that there will be around $10,000 of other related closing costs. The more borrowers there are, or guarantors there are, the more expensive. The more real estate there is involved, the more expensive. I do have some transactions if there's no real estate involved at all, and the guarantors own no homes. Might be only $5,000 or $6,000 in closing costs, but generally a nice rule of thumb is assume $10,000 in closing costs. There are two types of transactions, generally speaking, where the change of ownership rules come into play. A 100% change of ownership, I've decided I want to buy a trampoline park, or Wendell wants to buy a property development business. Minimum 10% equity. SBA does not use the term down payment, but it is essentially the same thing. The difference is that equity is either buyer cash or seller financing on specific terms. SBA says that, and I'm kind of jumping around here, I'm not going to go into A right at the moment, but a seller note where there are no payments required for the first 24 months that does not have a balloon note can serve as equity in lieu of cash by the buyer. A buyer literally doesn't have to have any cash to the change of ownership, but that's the SBA's minimum rules. A lot of banks are uncomfortable when buyers have none of their own money, but the one exception where we're almost always very comfortable is if that buyer has a close relationship with the seller, and what that normally looks like is an employee who's buying that business. Okay. Otherwise, go ahead.
Yeah. So Jesse, in that regard, I know we're going to look at this assisted living in just a second, right? So I guess in relation to that, they don't really know each other, so it's not that big, I would say a huge relationship there. However, the buyer that is looking to purchase the assisted living, they're currently running an assisted living facility now.
Great segue to this discussion over here. When an existing business operator, so you've got somebody who already runs assisted living facilities, wants to buy another business that's in that same 6-digit NAICS code that stands for North American Industrial Code System, as long as the ownership is going to be identical and that business is in the same geographic area as the acquiring entity, the SBA looks at that as a expansion project and therefore does not require any minimum equity.
Okay. All right. So let me ask you this. The geographic area, what would be considered the geographic area?
The SBA has been so kind to not define that for us, which means, let's make the argument. And I think here's kind of what we've talked about internally as a bank. If we're talking about, a business that you would expect a lot of competition, let's say a franchise restaurant. And actually this is not going to come out right, so this is maybe not a good example. I think geographic area is defined based upon how big or how small that business is. Let's just use a Montessori school or something for an example. You don't have a lot of those in the same area usually. And we could perhaps argue that even if it's 100 miles away, but it's in the same, state or, area, again, that's not terribly far away, we could say, it's a regional kind of an operation. Again, the point is that the SBA hasn't defined what a same geographic area is. If somebody operates in New York, a assisted living facility, and then they open one up in, the state of Washington, I don't think that's the same geographical area. But if they're, up in New York and then they open something in Boston or, that general same area, and they've got maybe several of them up there, I think we could argue that it's the same geographic area.
Right.
So it's kind of a case-by-case basis.
Right.
I hate to tell you, which again, I don't know if that's helpful or not helpful. But we would make the argument if we feel there's something that we can, some way to justify same area.
Right. Okay.
A lot of times it has to do with how quickly can you get there in a day? Is there management that maybe oversees, 2 or 3 locations and they rotate around and, that sort of thing? Are they able to be, can they share employees on occasion? There's a couple of different thoughts in our mind as to how we might justify what a same geographic region would be. It's important to note that, these are SBA minimums. That doesn't mean every single transaction, every bank is going to use the minimum. The bank can layer on their own or say, I'm just not comfortable with that, because maybe the operator's only operated that other business for the last 6 months or something. And I can tell you that I had that recently. I had an inquiry where somebody's only owned a business for the last 60 days. And they were looking to buy a second location, and they were new into the industry. And at that one, I said, I don't think I can get that approved. They're going to look for people who have had a business with an established, let's say 2 years minimum usually, in order to be able to use this business expansion rule. Okay. Going back, to these seller notes where there's no payments can be made at minimum for the first 24 months. Thereafter, they can make P&I payments. Interest can accrue during that 2-year period. But they cannot have a balloon note. And so we suggest that in most of these cases, the seller note should be on a 10-year note to match the SBA loan. If the business we're financing is a 25-year note because there is real estate involved, then we're more open-minded. We might expect that seller note to be on a longer amortization, maybe a 20-year amortization. We're going to still look at cash flow, assuming the buyer is making payments to the seller right from the get-go. And so there are a lot of transactions where if the seller note is the entire equity contribution, we might require that standby period be longer, because if it's on a standby with no payments for 5 years, then we do not have to include the loan repayment in our cash flow analysis. Does that make sense? And do you want me to repeat that?
Yeah. I'm just making some notes, and I'm going to see some notes here in just a minute as to what you're talking about right now.
Okay, all right. Number 4, a buyer doesn't necessarily have to contribute any cash to 100% change of ownership. And here's one thing it does say: a seller note that is on principal only standby for the first 2 years can also be considered equity, so long as the historical debt service coverage ratio for the last year and year to date is at that 1.15, and the buyer contributes 25% of the minimum 10% required injection. So if you've got a combination deal, some seller note, some buyer cash, and the cash flow supports it, we can allow principal payments right out of the gate. So that's a variation of this seller note, which allows some principal payments. Here's a really important item, number 6. Sellers can never remain as an officer, a director, or a key employee once the sale occurs. They are allowed to enter into a consulting agreement, but not an employment agreement. And that consulting agreement can only run for a 1-year period. It must be in writing. And the terms, whether they're, this is a paid consulting, maybe, we usually don't see a full 1 year. We see a lot of situations where it's only, 3 months, 90 days. Sometimes it's in person for the first 90 days and then by phone for the remainder. A whole variety of different terms. But consulting agreements, I want to be very clear. I've had business brokers, try to convince me that the seller's going to stay on for a year, and that mitigates a buyer who has no industry experience buying their business. And that is not how we look at things. Industry experience is really important. We haven't gotten to that necessarily in here, but I'm telling you, if a buyer is buying a business that they've never worked in before, they don't have any sort of prior experience owning a business or have transferable experience, it would be a very difficult loan request to get approved. Using your assisted living facility, if somebody came to me and they have been a nurse or a managing, individual of a assisted living facility, CVRF or whatnot, that would be okay. But if they have nothing associated with that, maybe they've owned apartments or hotels and now they want to get into this, that is never going to fly.
Right. So long as they pretty much, like with the people I've dealt with as far as operators when it comes to the assisted living facilities, like you said, most of those are either RNs or in some shape or form in the healthcare
capacity. Yeah.
Right. A doctor, or someone like that, who knows and understands, how all of that works behind the scenes, permits and things like that.
Right.
Yeah.
But so I do a lot of restaurant financing. Probably in the last 3 years, I've done more restaurants than I have in my entire career for whatever reason. And if that buyer hasn't managed, in a front of the house, back of the house, etc., capacity for at least 3 to 5 years minimum, it's going to be very hard to approve any sort of loan for a restaurant. Franchises are different. If we are financing the acquisition or sale of a franchise business, we do take into consideration the fact that there is training and support offered by the franchisor. And that's the one, exception to that industry experience situation. I actually have an individual who's buying a Midas muffler shop. They do not have any prior business ownership. One of the individuals involved is a auto mechanic, but being an auto mechanic certainly doesn't mean you know how to run a business. And the other individual who's going to be the primary manager, we're looking at the fact that they've got administrative type skills, but because they're going to be trained from Midas, we're okay with that sort of situation. But independent businesses, that's a whole different ballgame. So keep that in mind. A business valuation must always support what the asking price or selling price is. And earnouts are not allowed in seller, in these transactions. Earnouts imply that there is additional money going to a seller if certain milestones are hit or maintained. SBA just doesn't allow it. They do allow buyer rebates, but if a buyer receives any cash back from a seller, funds must then be used to actually pay down or reduce the SBA loan. And if a SBA loan is more than a 15-year term, there is a prepayment penalty for the first 3 years. And so there's a comment here that says, funds must be used to reduce the SBA loan up to a level that it does not trigger the prepayment penalty. Anybody with an SBA loan can prepay up to 20% outstanding of that loan each year. and not trigger a prepayment penalty. But again, if it's a 15-year note or 25-year note, there's that prepayment penalty, and it's a declining prepayment. In the first year, it's 5% of the principal outstanding. In the second year, it is a 3% penalty charge, and after 1 year, it's a 1%. After the third year, I should say, it's 1%.
So pretty much it's a decreasing prepay,
A decreasing prepay.
Yeah.
531. Yeah.
531. Okay.
Yep.
And what about a coin laundry?
Okay. What's the question about a coin laundry? It's a laundromat. You're right.
Yeah, a laundromat. Yeah, a laundromat. So I guess in that regard, I've seen some people go in and purchase a smaller laundromat, but with no experience. Now I guess they'll get experience, and then of course I guess they'll be able to work themselves up to purchasing, a larger laundromat.
That's a really great question, because you're right. A laundromat, as an operator, I would assume the important things are you have to keep the place clean, make sure your machines are in good servicing they're working all the time, and you're collecting your coins and you're making sure that your soap dispenser and your change dispenser are full all the time. So I don't know, that might be one of those exceptions where someone without any knowledge or prior experience and ownership of a laundromat could probably get into that industry.
Right. Okay. And what about a FedEx route, a FedEx or an Amazon route?
Well, funny that you should be asking about that. I don't know if you know this, FedEx has been having a lot of problems. Many banks right now, including our bank, made a number of FedEx route loans in the last several years, and they are not performing well at all. So I would tell you that right now, you would be hard pressed to find many SBA lenders actively. Certainly nobody's pursuing them anymore. And there may be a lot of banks that simply say, no thanks. Because there's something I learned as well just last week, that in the FedEx dealer agreement, FedEx has the authority to buy back a route, or take over. Let me use that term properly. Take over the route if it is failing in front of the bank. I don't know how that language ever got missed by the SBA or by the lenders that are involved, but that clause, means a bank is really SOL if they have a default on their hands, and a lot of banks do right now. I can't comment on an Amazon route. I think the whole route business right now would be very challenging to get SBA financing. This part here, this partial change of ownership, it may not, be a big deal to you if you've not been involved in acquisition financing in the past. But this rule was rolled out last November, and it was like mind-blowing because it's never been allowed before. I have not yet done a deal where somebody's taken us up on this, but I'm sure there's got to be the right scenario, and we just haven't found it yet. But a seller can hang on to a portion of the business and sell, a portion of it to someone. Again, don't know exactly what ideal situation this fits for. I always envisioned that it would be most likely used by someone who does have an employee on their staff that they feel would be a good potential buyer, but maybe, they're not ready to sell everything to them. But the hook or the rub of the deal is that seller, if they remain with 20% ownership, would have to personally guarantee that loan. And so, the funding is going to, or the borrowers in that case, is the company as well as the new owners. They are the co-borrowers. But then again, a seller who has at least 20% ownership would have to personally guarantee that debt. That's, in my opinion, why it hasn't been very embraced by anyone yet. But I look at that and I think to myself, if you have a seller who's willing to, a lot of times there are transactions occurring that I never see. And when I say I'm talking about lenders never see. Buyers and sellers just negotiate them on their own. There's no brokers, etc. They don't know that this SBA program is out there. And so that they may be doing 100% seller financing, which of course is as high risk as guaranteeing a loan. Although the only difference, I suppose, if they structured it properly and legally properly, if the borrower defaults, they just, that buyer's gone and they still own the company depending upon how they structure that transaction. But the point is that there's an opportunity here to uncover some prospective new borrowers if more business owners knew that this was an option. They could ease into, the sale perhaps as well. The one thing here, let's see, I like to point this out, maybe it's overkill, but if a spouse also has ownership in a company, and a lot of times, you'll see a situation where the spouse has 2%, 3% ownership, and they don't think that means anything, but SBA rewrote rules a few years ago that says, regardless of how much ownership that spouse has, if they have some and combined a husband and wife have over 20%, then both of them are guarantors. And SBA or the lender always has that opportunity to add other individuals or entities as guarantors, even if they do not have the minimum 20% ownership. So keep that in mind. Things can always layer on and say, hey, we like the deal. We had a deal last week. It was an online retailer that wasn't a very old business. The buyer was a little bit shaky, but his parents agreed to be guarantors, even though they had no ownership, and they had very nice personal financial statements. So we were willing to then say yes to that deal because of that outside guarantors. I'm just throwing this in there. We don't see a lot of general partnerships as borrowers. 1065 usually is their filing with the IRS. But for whatever reason, a general partnership, all borrowers must be co-borrowers, even if they don't have 20% ownership. Also, this is important. If the target business balance sheet for the most recent completed fiscal year and the current quarter reflects a debt to worth ratio of no more than 9-to-1, so no more than 9 is the debt to worth or equity ratio. So if and 9-to-1 is a very leveraged company, by the way. It's very leveraged. Most conventional lenders don't want to lend money to companies that are more than 4-to-1. So this is pretty generous. And there is a partial ownership buyout taking place. No new equity is required by the buyer. If they are more leveraged than this, then the borrowers must contribute cash in the amount of at least 10% of the partial change of ownership purchase price. It's a lot of information to absorb on this partial ownership thing. So anytime somebody's talking about it, I would say, let's get on the phone and talk about it.
Yeah.
Yep. The rest of this is really just a checklist for people to understand what it is that we're collecting from sellers. Right. We're always going to have 3 years worth of federal tax returns unless the business hasn't been owned by someone for that long, which therein is a little bit of a red flag anyway, right? We want sellers W-2s. We ask for financial statements in addition to the returns if we can get them, because there's almost always some additional good information in the P&Ls and the balance sheets. We always have to be working with financial statements that are within 60 days old. It's shocking that we're in September, and last week I was still talking to people who hadn't filed their 2023 tax returns and they're looking for a couple $1 million.
Yeah, I know.
I don't know what they're thinking, because you can't get a home loan without some current financial information, but very adamant that financial statements, sure, we can look at them for 2023, but I'm never going to issue a proposal letter based upon them, because we just don't think they usually remain as rosy as once they're turned into their tax returns. So we'll be asking for pay stubs from sellers or managers if they are not if the owners aren't actively involved. We may ask for managers pay stubs if they're being replaced by the buyer. I have a seller questionnaire that asks a lot of questions about whether there are family members working in the business, if there are people who are getting paid more than market rates, if there are personal expenses being run through their company, how many hours they are working. We try to get some industry insight, just different things. And that serves as a great tool for underwriting as well. We use the questionnaire to give to the business valuation expert, saves the seller from answering the same questions multiple times. If it's a business like a manufacturing firm where they would have business to business type clients, we might ask for top 10 reports, or at least want to know more about the industries that they serve, etc. Whatever reports a business might use that are typical of that particular industry. Hotels, of course, have star reports, that sort of stuff. Same thing is true for assisted living facilities. They've got their census information and data. And if there's any personal expenses being run through the business, we will take those into consideration in our analysis if we can provide or be provided with verification or documentation to prove that out. And the best example is if somebody's leasing a car, but it's a business that doesn't require a car, or cell phones for their entire family, if they can show that they're paying a family plan, those kinds of things. If I'm not unable to get a seller questionnaire, I'm doing an analysis, I'm going to ask these kinds of questions. Are there any customer concentrations? I'm always going to try to understand what their cash conversion cycle is. Are they paid deposits? Are they, giving terms? Or is it only cash? Those kinds of things. We always want to know who's in charge of sales and client relationships. If that's the seller, that's a bigger red flag. I work with a lot of contractors. It could be an electrical contractor, plumbing, or even a builder. And we want to see, who's responsible for job costing and that sort of thing. If that person who does all the quotes is walking out the door upon receipt of their cash, then we probably have a little bit of a challenge on our hands. This third page this is the minimum buyer information that I would like to know if somebody is, looking for to buy a company. How many people is involved in this purchase? What will their ownership percentage be? And I've got to provide this to the SBA, so that's why that's there. I'm going to collect the same thing from them: 3 years worth of personal tax returns, a personal financial statement, and a resume. Our resumes are very short. They don't have a lot of detail or space for what was your prior jobs and employers. So I always tell people they have to think of the management resume as the tool that is selling themselves to us. Plus it has some qualification or qualifying questions that are very important to see that they are eligible for SBA. I always want to get a driver's license, SBA and the banking industry, know your customer. And we want to know where their money, if they're putting money in, is going to come from. And it's very specific because we eventually are going to be collecting their bank statements or their investment statements, wherever that money is sitting. If it's with their mother and that mother is going to gift them money, we need to know that up front. So these are important for brokers to know. And these are the type of questions that I generally ask all potential buyers of a company, because we want to know, are they going to be actively involved in the business? The SBA program is really targeted to owner operators, not investors who are just putting managers in place and then running the business from afar. So we ask how much they intend to pay themselves, and will they be replacing any people, so we can figure out what the appropriate add backs are. And I like to know what it is about that business that attracted to them. And I use that question a lot when it's a very unusual kind of a business that, I've never seen before. And there isn't really a good tie into past experience. Maybe the laundromat's a good example. But I've seen some very weird businesses that I never knew existed before. So I ask about their assumptions about their income and expenses. And we see a lot of applications where people are living in, New Jersey and trying to buy a business in Illinois. And it's like, what's going on here? Are you going to be moving or not? I've had people buy businesses in other states, and we required proof that they sold their home, proof that they have a new lease if they're leasing, or if they've purchased another business before, or a home in the state that they're moving to. So we've got some weird ones. It's very hard to get a loan approved for somebody that's in one state when the business is somewhere else. And 10 years ago, I didn't see that at all, but these days I see it all the time. So that's the conclusion of my conversation. So I'll turn it over for questions if anybody has any.
Yeah. Well, I'll let the team go up, see if anybody, see if anyone has any questions. If not, then of course we can talk about that assisted living facility.
All right, that sounds great. I appreciate everybody joining us.
Yeah, absolutely. I totally agree. I know it's a little difficult getting in, but I'm going to try to make it a little easier next month. So that's going to be my goal. So of course, in regards to that assisted living facility, the one that I sent over to you.
Yes.
So like I said, they are currently operating a facility now. They're looking to expand. Okay. And the facility I sent you is about 2.3 million.
Right.
So credit scores are good, 680 plus. And I'm going to work on collecting, everything that's on the checklist. Okay. And which I already have my application and all that, the PFS form and all that kind of stuff for the borrower to complete.
Okay.
Now, they've been operating their current location for about 10 years.
Okay.
Okay. So now they have about $200,000 in equity in their current home.
Okay.
So I wanted to see, like I said, at about $3 million. Okay. Just based upon what you've seen in the past, someone who wants to acquire an existing business, and they asked me, I told them I didn't know, that I was going to have this call with you. Just wanted to see what what you thought, would possibly be, a good percentage down, so I told him initially, I told him 30%. So just to be on the safe side. Now, if we can get them into the property with less than 10% down, at that point I'm winning. You know what I mean? Because I didn't oversell and underdeliver.
Right.
So basically, I just want to make sure that, hey, if I'm saying 30% and it could be a whole lot less, but the other thing is, can we roll in the closing cost into the transaction?
Yep. As I said, when I look at a project, I'm not only adding the closing costs into the use of funds, I'm also trying to figure out how much working capital might the buyers need.
Gotcha.
So, here's the key, Wendell, to all of these deals. Cash flow, cash flow, cash flow. So all I'm doing at first is, all right, what's the asking price or the selling price or whatever number they've got for me to work off of? I'm going to run the numbers for the past 3 years. I'm looking for sales trends, gross profit trends, and cash flow and net income, trends. And do we have cash flow and repayment ability in the most recent year end and year to date? If, based upon essentially 90% financing of the project. So, they buy it for 2.3 million. Let's say this particular, I don't know if these are public pay, private pay, what the, what the timeline is to get all set up so that the cash starts flowing in. I don't know if this is general population. I assume it's general population and mostly private pay, but we need to have cash flow based upon the history, not projected. And so I don't have enough information here I did look at what their assisted living rates are, and they're very low. They're much lower than their competitors that are in there. So that doesn't give me a whole lot of hope, frankly. They are a memory care provider, and even their memory care is much lower. And it's hard to make money in this industry unless you're serving a niche. I happen to do a lot of assisted living facilities for operators that have niches. They serve, disabled individuals, people who are suffering from mental illness or physical disablements, etc. And they have a lot of public pay programs. This one doesn't seem to have that. And if I look at, again, I haven't looked at all the Excel documents that you sent me. I only had time to open up one, but going through their memorandum, the financial information, if I'm reading this right, it's a negative EBITDA number, which I don't understand that at all. And they have 2023 income. Let's see, sales are $1.3 million, but it looks like their net income is a loss of $20,000.
Yeah, and it looks like within the last year, it looks like the NOI has, gone positive, but again, it's not exorbitantly positive. You know what I mean?
Right. Well, so SBA is not the loan program for turnarounds. That's not to say with the right buyer, right now, I am working with some folks that I've lent money to twice in the past. They have a niche, and they are buying a general population failing non-profit assisted living facility. And they can show me and explain to me, hey, right now, their average client or patient monthly income or payments, if you will, are, I'm trying to remember what it was, $4,000 a month. Well, when they convert this to a facility that only accepts individuals who qualify for a state program or waiver program, they're going to be able to collect $6,000 to $9,000 to $10,000 per patient. And what they've just got to do is get through that conversion cycle. And so they do an assessment with each one of the existing clients that they have or patients that they have. Some of them will probably turn out to be eligible, and some of them will not. And the ones that are not eligible, they can't kick them out, but through natural attrition over time, they will convert them. So if there's a situation, and let me back up, in that particular project that I just described, they've got a ton of equity in other real estate. So while they're only going in with the minimum of 10%, because we're going to have a lot of other collateral, we have a mitigant to the whole thing. So if somebody's trying to do something where they're taking a business that's not been successful, at least from what we see on paper, they're either going to have to kick in more money, lower the loan amount, or have some additional collateral, or have something to provide us with some comfort how they're going to turn this thing around. So this one is right now doesn't look great from what I can see, but I certainly need more information, and I don't like the spreadsheets that somebody else puts together. I always go for the hard numbers. Get me the tax returns for the last 3 years and the current financial statement. Give me some information about our buyers. Tell me how strong they are. You told me that they've owned one for the last 10 years. But, was that a turnaround when they bought it? What can they say about this one? This property is already over 20, almost 30 years old. If there are a lot of younger competitors in the area, that probably explains why they're getting much lower rates than everyone else is. But, those are my observations from the 10 minutes that I had this information on my desk before this call started.
Okay. And how long do you think it will take to close something like this? Let's say all the numbers work, everything looks good.
I used to tell people that most projects should close start to finish within 90 days. Now I don't even pretend to answer that because I don't know all the different obstacles that are possibly, and I don't know how long it might take them to get a purchase contract. So, you know, it closes when it closes. And I say that genuinely. I have more projects this year that are taking 6 months because people aren't very organized. They don't have their tax returns done, and it's just a waiting game constantly. I really don't know anymore. It's really challenging.
Okay.
Unless there's sellers that have, you know, are putting the right pressure on the buyers, deals are just taking forever for some reason.
Okay. All right. Well, hey, Jesse, if no one have any questions, you know, hey, I guess we can, you know, call it a day. And next month I'll be more prepared. I'm going to have a better link for us to join next month and everything. And look, you know, again, I appreciate you, you know, of course, sharing the knowledge as to what a person can do in order to go out and acquire an existing business. You know, of course, it has, you know, put me in a position where I'm thinking about, you know, different avenues to go out and generate business. So, you know, again, that's why, you know, why I would like to invite realtor partners on so that way they can go out and see if they can locate businesses that we can, you know, of course, you know, for expansion, you know, that their buyers can go out and buy for expansion, things of that nature. So of course, that's the absolute goal of this is to, you know, right now in this market is to help everyone that, all my partners to help them go out and find different ways to generate income, generate more business, generate more prospects. So that's our ultimate goal. And I think, you know, this is something that, you know, we all can add into our arsenal to go out and in order to do that. Hold on, you were muted there. You were muted. Okay. All right. Go ahead, Jesse.
Can you hear me now?
I can.
Okay. I said, feel free to call me or write me anytime you got a project that comes over your desk.
Yeah. I certainly will. And thanks again. And thanks everyone for attending. And we'll see you guys next month.
Thank you.
Bye, Jesse.
Bye-bye.